Everyone makes it seem like becoming a millionaire is so easy. Just put $100 a month into the stock market and retire a millionaire. Except there's more to it than that. I'll show you. If you want to be a millionaire investor, you need to know how to get started. Put it all in Tesla! And YOLOing your money is not the right strategy. If you want to increase your chances of becoming a millionaire, there's an order of operations of how you need to go about investing your money into the stock market that I want to go over with you. There's a difference between having investment money, which is going to make you rich, and there's a difference between having savings money, which is there to protect you against an emergency. If you do not have $2,000 saved up right now in a bank account that's there to protect you against an emergency. This is not cash that you want to use to go out and buy a TV, buy a home, buy a car. This is $2,000 saved up just to protect you against an emergency. Before you think about investing your money in the stock market, I want you to go out and save $2,000 as fast as possible. And the reason why is you don't want to use your stock market money as an emergency savings fund in case something goes wrong. Because let's just say your kid breaks their arm and now you need a few $1,000s to cover this expense for whatever reasons. If you don't have this cash in your savings account, but you have this money in the stock market and you don't want to put it on your credit card, well, now you might be forced to sell your stocks at a bad time. You might be forced to sell your stocks in the middle of a market crash. You might be forced to sell your stocks when you don't want to sell, and now you're liquidating your stocks, you're liquidating your lifetime investments, you're liquidating your retirement account just to pay off this expense. And that's why the first thing you need to do is you got to save $2,000 as an emergency fund. And this is where I want you to remember is you want to ideally have 3 different bank accounts. One bank account to hold your spending money, one bank account to hold your investing money, and one bank account to hold your savings money. Now, of course, your investing money needs to be invested, but depending on what your strategy is, sometimes you might need this money just sitting there on the side, waiting to be invested, versus some of you are going to have this money automatically invested. We'll talk about that a little bit later in this video, but this is where you want to understand this difference between your savings to protect you, and there's a difference between your investments, and you got to have this before you start investing. The second thing that you want to do before you invest your money in the stock market is pay down any high interest debts, and let me show you why. Let's do a little math problem. According to Forbes, at the time of me recording this video, the average credit card interest rate is right around 27%. And then according to Investopedia, the average historical stock market return over the last century is about 10% a year. So now if we do a little bit of math, what you'll see is that the average stock market return is a whole lot lower than the average credit card debt, which means from a math perspective, you are going to get a better return by paying this down before you start putting your money here. And not to mention that this has a guaranteed return. If you can pay your credit card off 1 year early, that's a guaranteed 20, 25, 27% return because you paid off your credit card debt early. Versus when you put your money into the stock market, well, remember, this is an average. Sometimes the stock market will grow more than this. Sometimes the stock market will grow less than this, and sometimes the stock market will shrink. So when you put your money into the stock market, there's no guarantee of you even making money or how much money you're going to make next year, versus when you pay down your high interest debts like your credit card debt or your payday loans, you're getting a guaranteed return, which is why before you start worrying about putting your money in the stock market, be aggressive in paying this off ASAP. Once you do the foundational stuff of saving your first $2,000 at the very least, and then you work to pay down your high interest debts, now this is where you can actually start preparing to actually invest your money into the stock market. This is where things get fun. This is where now you can start building the mindset of an investor. This is where number 2, understanding that you want to be investing your money for the long term. Number 3, understand that, well, there's a chance that you could lose money and you don't want to invest more than you're willing to lose. And number 4 is you got to understand the risks involved with investing as well and make sure that you are ready to handle those risks and seeing the market potentially crash. So now when it comes to building the mindset of an investor, what you'll see is that these first 2 kind of go hand in hand. As an investor, what you need to remember is that wealth goes to those who are disciplined and to those who are patient. Warren Buffett likes to say that the stock market is a device that transfers money from the impatient to the patient because the impatient are trying to chase stocks. They get excited about what's happening in the news, they hear about this new hot stock, and they throw the money in there thinking that they're going to get rich because everybody else is getting rich from it. But when you play that game, well, you're going to be the person that's making everybody else rich, because what ends up happening is you buy when things are going up, and then when things start to go down, that's when you panic and that's when you sell. We don't want to do that. So you want to build a mindset of understanding that this is not the game that you want to play. You're not trying to just chase what everybody else is doing. You're going to have your own strategy, and you need to be able to cut through the noise and not fall into those same traps. Number 2 is you want to be a long-term investor, which means that now we're not talking about trading stocks. We're not talking about buying something and holding it for 6 months. We're talking about buying something and holding it for the long term, maybe even for wherever, depending on what your strategy is, where now you're looking to buy investments that you believe in for the long term. That way you can build long-term wealth, because the most wealth is built from that long-term investing, not from the trading. Traders can make a lot of money in the short term, but then they can lose that money just as fast. We're talking about how do you build long-term sustainable wealth, because that's how wealth is actually built. And then understanding that you don't want to invest more than you're willing to lose. Sometimes people get excited about investing the money in the stock market, especially if you get started investing during a bull market, meaning when markets are going up. People can get very excited. If you put your money into a good stock and you see your money grow by 20% very quickly, now you get excited. And you think, wow, what if I just use some margin or some leverage or some debt? Now I can make even more money. Or you take money that you can't afford to lose and you put it into the markets because you think you're a genius investor because of what you did in the last 6 months. But this is where I want you to remember. You don't want your emotions to get the best of you. You don't want to invest more than you're willing to lose, because markets go up and markets go down. Your goal is to make money over the long term, but you don't want to take that risk with money that you can't afford to lose, and understand that more margin means more risks. And especially if you're a beginner investor, please don't even think about touching margin. I don't mess with that stuff. And I don't recommend that to anybody who's just getting started as an investor. You want to be a long-term investor who's understanding how do you actually build wealth in the markets, not trying to play these trading games. And then fourth, understanding that there's risks associated with investing. Look, the stock market goes through booms and busts. This is a part of our economic system. Our stock market crashed in 2020. The stock market crashed during the 2008 crash. The stock market crashed in the year 2000/2001 during the dot-com bubble. Yet, our stock market has still been resilient since then. We know that the United States economy has gone through crap, and we will go through more crap in the future. However, even though we've gone through it, we've become stronger each and every time. And this is where you gotta remember that there's booms and busts in the market. Market crashes happen. They have happened, and they will continue to happen, and in fact, probably get more severe in the future because of the amount of debt out there. This doesn't mean that you shouldn't invest your money, but this means you have to understand this, because when you go through those bust periods, those down periods, there's a lot of negative sentiment, a lot of negative emotion of people thinking that the world's going to end. And when you go through the boom periods, there's a lot of excitement and exuberance and just people thinking that nothing could ever go wrong. And this is where you want to be more of that disciplined investor and not get caught up with these emotions, and understand that if you have a good strategy, you will be able to weather the storm, and you will be able to make even more money, assuming you understand that those down periods create opportunity for you to buy even more, and the up periods are the time now for you to realize your profits. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.